Well, good morning and welcome. I see a couple of members, one from the Dallas area, one from the Houston area, um, two from the Dallas area. If you have any problems seeing the slides or the presenters or hearing, if you'll let us know in the chat box, that would be terrific, and we can address those technical concerns before we get started. So Daria, Vince, Dustin, you guys are in mute mode. You'll have to communicate via chat if you have any concerns. We're going to give it just a couple of minutes as people join the call, and then we'll get started. Thank you, Daria. She says hello. Yes, she can hear. Um, Couple from Dallas, Houston, Amarillo. Welcome, Patrick. Glad that you're here. Let us know if you have any concerns hearing or seeing the slides or the presenters. Terrific. All good. Can hear and see. All right, we're just going to give it another minute and then I'll do some introductions and we'll get started. All right, I have straight up 11:30, so we are going to begin. Good morning and welcome. My name is Teresa Campbell, and you have joined the PIM Printing Industry Midwest and PIA Mid-America Financial Executives Council presentation on mergers and acquisitions. Now, I want to note that all of our attendees are initially placed in mute mode so that we can get a quality recording, which will be provided in the coming days along with the PDF of the slides. But we really encourage comments and questions during the program. We ask that you type them into the Q&A or the chat field, and those options are at the bottom of your screen. Now, they may be asked later in the program when we know that we're going to get to them, or the presenters may say, we have a slide for that, so we'll answer it here shortly. So be patient, but we'll get to all of those questions. Those that are new to the group, the Financial Executives Council is coordinated by leaders in both the North Central and South Central regions of the U.S. They guide the programs and content offered 6 times a year, and they focus on financial reporting and compliance, data management and security, and financial policies and planning. Now, before we get started, I want to mention that our National Wage and Benefits Survey is now open. Workforce challenges continue to impact all of manufacturing, and certainly print is not exempt to that. These reports are specific to our industry and provide extensive year-over-year data to assist you with recruitment, retention, and benefits management. If you have not started your survey yet, we will be contacting you to ask for your participation. Without further delay, I'd like to introduce our Financial Executive Council co-chairs. They are Carl Nathy with Myers Printing, Ryan Wagner with Action Mailing and Printing, Ken Rain with Wallace Carlson Printing, and Matt Wills with LB Carlson. Matt, will you introduce our presenters?
Thanks, Therese. We'd like to welcome back Mel Enger and Don Polfliet from LB Transitions. Together, they bring numerous decades of experience advising middle market companies through successful sell side and buy side M&A transactions in the printing and related industries. Together, they focus on maximizing value and ensuring smooth deal execution from preparation and execution of transactions through valuation, marketing, and negotiation processes in the competitive and complex markets of the industry. So without further ado, Mel, Don.
Okay.
Thanks, Matt.
Yeah, thank you, Matt. Yeah, I'm going to kick things off here. Mel Enger. And Matt mentioned LB Transitions. Maybe more people know us from LB Carlson, but LB Transitions is a separate firm of LB Carlson that focuses on the M&A work. And Don and I head up that firm, and we've worked together for many, many years. And we've done several transactions together. And I wish I would have kept track of these all these years, but we think we like to say that 3 out of every 4 transactions we do are in the print space. So a lot of print related transactions over the year. I'm just going to make a few opening remarks to talk about what we're going to cover today and what our agenda is. Not sure why everybody joined today. Maybe you're just curious. Maybe you're in looking to buy something. Maybe you're thinking about selling. We'll try to touch on all these different things. Don and I have done this M&A presentation before, but we're taking a little bit different approach today. In the past, we've kind of went through the whole process, the whole step by step, and we thought it might be maybe more interesting to talk a little bit about the marketplace, what's going on out there. We get asked that a lot, what we're seeing. Actually, prior to this starting this, Ken Ryan asked what's going on out there. So we're going to touch on that. And then we're going to dive into what we call keys to successful transactions, things to look out for, keys to success, some things we call the pitfalls. We thought that might be a little more interesting than walking through all the different steps. And then we're going to wrap up at the end, as Teresa mentioned, with some Q&As. So please chat those in. And if something's appropriate to discuss during the presentation, maybe Teresa or somebody will interrupt us and we can do that. If I will mention, if you have some personal questions that you maybe don't want to chat about in front of this whole group, you can always email Don or myself, and we'll get back to you in due time. Okay, so Don, you want to flip over to actually the next slide, if you could? We're going to start out with the M&A marketplace and, print, obviously, and just in general. I'm just going to cover a few things and then hand it over to Dawn, and she'll get into some metrics and other industry tables and so forth. So this is another question we get asked, like, what's going on out there? Is it active? Is it slow? Whatever. I'd like to start out by saying, you think back to the COVID years. Now we're talking already 5-6 years ago. And if you all remember back then, about March of 2020, I think Dawn and I at that time had, I think, 6 or so transactions in different phases going on, and they just all stopped. I mean, there was so much uncertainty that the whole M&A market shut down for several months. It seemed like it did pick up later, but since COVID, it seems like every year that somebody's predicting a slowdown in M&A, and I don't think it's happened since COVID. I think it's been continued to be very active, but people think, political things, elections, just the uncertainty with the economy, interest rates, tariffs, things like that, people think are going to slow down the M&A activity, and I don't think it has. There's certainly been some ups and downs, but for the most part, it's just been very active. A good indication of that is Don and I literally every day get emails from private equity investors that they want to know what we have out there. Do we have anything that fits their criteria and so forth? Every single day we get emails from those folks. We have quite a large database that we market to, but obviously an indication that there's money out there. They need to invest that money. That's how they make money, of course. And I know there's stigmas about private equity, but they're here to stay, and they're very active in the print industry. We've done several transactions with them. But that's one indication of how busy it is out there. And of course, the organic growth versus growth by acquisition. We all know organic growth is difficult, and that is still, it seems like everybody's preference is to grow organically, but it's hard. So people complement that through acquisition, and that's what you're seeing. And of course, continued consolidation. There's been a lot of that in the print industry, and that will probably continue as well. And then, of course, there's the baby boomers, that they're of an age now, the business owners, that it's time to get out. And so, to summarize all this, is it a buyer's market or a seller's market? It's hard to say. I mean, there's a lot of money out there, so you might think it's a seller's market, but there's also a lot of companies that are looking to transition. So I just think it's a very, very active market, and it'll probably continue to be that way going forward. So I'm going to hand it over to Dawn now, and she'll get into some other slides.
Okay, yeah, thanks, Mel. So Mel already mentioned this. We do get asked all the time, how active, what are you seeing? And Mel shared some of his personal experiences. I'm going to share some charts. There's lots of organizations that track this information and deal activity. And I got a couple slides on that. This first one is from the Institute for M&A Alliances. And they've tracked this for, I think it's 40 years, over 40 years. And you can see a nice, upward trend over time in the deal activity. The blue bar graph is the number of transactions, and the black line is the value of transactions. And this chart represents deals in North America. They track information for all over the world, but I pulled just the North America chart. Couple comments. 2021, you can see, was a record-breaking year. And Mel commented a bit on COVID and how things slowed down. And this is, I think, reflecting the post-COVID and getting a lot of those deals done and transactions completed in 21. 22 kind of back to where it was before COVID. 23, a little bit of a reset. And then since then, it's been increasing each year. 25 was up, let's see, I did the math, 9%. And the expectation for 26 is going to be up another 12% in number of deals. So a lot of optimism about activity and how busy the market is. One thing I want to point out on this graph, this dip, this dip looks a little confusing. What does that mean? It's because they're only presenting 1/4 of information here. So if you annualize that, you can see the projection is for increased activity into 2026. So a lot of optimism there. Go to another chart. Here, this one is from PitchBook, and PitchBook tracks private equity deal activity. So we've had some questions on private equity. Also very active. This one's for 10 years of transactions. Both venture capital and private equity firms, upward trend again. Same trend in 21 where there was more deals, kind of reset, but increasing each year. And like Mel said, we are contacted multiple times a day by private equity. So they're still very active. So I talked a little bit about optimism for 26. Deloitte does a survey every year, and they ask this question: do you expect the average number of deals that your company closes to increase or decrease over the next 12 months? And they're asking private equity and corporate deal makers. And 84% in their survey said we expect that there will be a greater volume of deals and greater deal value over the next 12 months. And they've said that same thing for the last couple of years, which, I think corresponds to, this increase each year. So 2026, all trends seem to indicate it's going to be a really active year and lots of activity going forward. So what types of businesses are being acquired? This is a chart put out by Pepperdine from their survey. And this is recent data, transactions closed in the last 12 months. And this is for private capital markets. Thought this was interesting. The largest percentage was in manufacturing for deals that were closed. Then 19% business services, 12% consumer goods, IT, wholesale distribution, and on down the line. But the fact that, the largest category is manufacturing, I think that's a really positive sign for the print industry. So overall, I guess the message here is the market is active. Expectations are high for closed deals in 26. And like Mel mentioned, I think a lot of that is because interest rates are starting to come down. Some of that uncertainty that people were maybe holding back a bit, that is cleared up. The second most frequent question we probably get is, what are multiples doing? Right behind, how active is it? What are multiples doing? This chart is from a resource that we subscribe to called Deal Stats. And Deal Stats tracks private and public company closed transactions, and they've been doing it for over 30 years. Last time I checked, they had close to 60,000 transactions in their database. And I do a lot of business valuation work. I'm an ABV, and I probably have done over 150 valuations. And I use this as a resource where you can go in and search by type of company, size of company, industry, and filter the results. This chart I'm showing you now is a summary of all industries and what the trend has been for all time periods, which is the gray bars, compared to the last 12 months. And this is a really current chart. This is from first quarter of 26. So you'll see this blue line. This is the median for all industries, across the last, that's a 12-month measure for all sectors. The 4.0 is the median, and that has been pretty consistent. I looked back the last couple years, and it's kind of in that same range. Within the categories, you'll see IT, finance, and insurance. They're on the higher end of the range, have been for a while. Food service, arts, entertainment, recreation on the lower end of the range. That's not really all that different either. What you're probably most interested in is the manufacturing. So that's at 4.7 for the last 12 months. That is up a bit. The last one I looked at a couple years ago was about a half a point less than that. So that is trending up a bit, which maybe coincides some with this, interest in the manufacturing sector too. So I think that's all positive news. So you're probably wondering, what about print industry? It's a very wide range. It's always a really hard question to answer. What about print industry multiples? Because it varies so much. And we have honestly seen anywhere from 3.5 to 12 in the deals that we've done. So depending on the type of work you do, the profitability and lots of other factors, which we have another slide coming up where we're going to talk about some of those factors. It can be anywhere in that range. A lot of times what I'll do when I'm doing evaluation, because so many of you do lots of different things and not you don't really fit just into one bucket. We'll do a blended multiple approach. And what that means basically is if you're doing large format or you're doing commercial work, packaging work, we'll carve out those pieces of your business and the margins and come up with a weighted multiple. And it's just one way to look at it and try to get a little bit more accurate with what you might expect to see for a multiple.
Don, could I
On
interject a couple of things?
sure.
Um, I'm not sure where you're going next, but yeah, like Don mentioned, we do get asked this a lot, and it is hard to answer specifically. We try to start with averages like Don was referring to. Um, but sometimes that's not that exciting for people to hear about an average. And so what we like to tell people, especially if you're on the sell side of the equation, is value means different things to different people. That's kind of our tagline, which means if you ever go to market and experience this and start talking to a lot of potential buyers, you're probably going to get a wide range because what they see in your company might mean more to them and they're willing to pay more. So the averages are important to set a baseline and an expectation, but it's generally a pretty wide range.
Yeah, that's very true. Whenever we take a company to market, we'll see a really pretty wide range of values coming in on the offers, surprisingly wide range sometimes.
There's a question from the group before you move on. In your experience, are acquiring companies purchasing similar businesses or businesses with different capabilities?
That is a good question, and it's both, right? I mean, sometimes strategic buyers are looking to complement what they already have. I mean, private equity, they're usually trying to build a platform, right? So they're looking for something that they can build upon what they already have, and it may be something very similar, or it may be something that diversifies them a little bit. So I don't think it fits one thing fits everything there, Teresa. I think it just depends on the buyer and what they're looking for. And it's, our job if we're representing the seller to figure that out, right? And buyers are never going to come and purposely pay more. It's kind of the job of the seller or our job to figure out if this value proposition means more to them than somebody else, then, we want them to pay a premium for it.
Excellent. Thank you.
Okay, the other thing I wanted to mention here is this third bullet point. When you talk about the 12 plus multiples, those were from this 2022-23 time period where there were some people have referred to as like aggressive auction type dynamics, where there's just a lot of interest, a lot of parties going after primarily label and packaging companies. Since then, we've seen some downward pressure on those multiples. They've moderated some. Now the focus is more on, as it should be, on profitability and cash flow and what makes sense for the multiple. So instead of the 12 plus, those are maybe more in the 8 to 9 range for larger companies. So that has been something that has been more of a recent, in the last, I'd say 12 to 18 months change. Still highly desirable, but probably not in that 12x multiple. I did look at deal stats for recent transactions for the last 5 years and did a couple different sorts here so you could see how size impacts this. So for 3 to 10 million in revenue companies, the 5-year median was 4.1, range from 2 to 7. Larger, 15 to 75 million in revenues, the EBITDA multiple was 6.3. So this is again a median of all types of print, packaging, labels, all related categories. So it's not specific to a certain type of work, but it does illustrate that the larger, the more revenue you have, typically the multiple does go up. And this chart on the right is an all-time median for the print industry, 5.6, and shows a similar range to what Mel and I've seen in the deals we've done. Okay, this chart is public company valuation multiples, EBITDA multiples for packaging and labels. And this is as of 2025. This quarterly information is pulled and put together by Lincoln International. And I think I put this in here because I thought that illustrated nicely that, these have kind of gotten back into that 8 to 9 range. And like I mentioned, that is kind of what we're seeing too, for the larger companies. So, what impacts multiples? I put in here top two in my opinion. Hopefully Mel agrees with this. I think he does. Top one, premium niche, having something that's unique, complex, specialized, something, whatever your special sauce is to make that customer really sticky, difficult to leave. Maybe it's pharma work, special certifications, whatever it is, something that's in high demand and sticky. That is a key. And then the second key, EBITDA margins. If you can get in that 10 to 15% range, that is really attractive. And we've seen deals where it's much higher than that too. Get into the 20, high 20. And EBITDA margin is EBITDA as a percent of sales, just so that's clear. So if you get in that 10 to 15, that's attractive. You get up in the 20s. And if you combine that with a premium niche, then you should expect a premium multiple. Other influences on multiples, revenue. I just kind of illustrated that with the average multiples, and growth. PE firms in particular, I mean, everybody's looking for growth, but PE firms in particular are looking for growth opportunities, and that's really important to them when they're evaluating a transaction. Current technology, well-maintained equipment. We get this question every time. What's the CapEx? Have they kept up on the repairs? Is everything well maintained? If it's not, there's usually, some kind of deduction or reduction in the multiple. Account concentration, 20% or higher causes concern. We've dealt with this frequently, and the key here is to build a case for why that customer is really sticky. And we'll spend a lot of time building a strong case around if there's a concentration, why is that customer going to stick around? Why is it difficult for them to leave? And that works in a lot of cases, and buyers are interested in that. In some cases, I mean, they have hard and fast rules where no, we won't look at it. So you do, if you have a high concentration, you do lose some potential buyers. But a lot of times, if you can support the stickiness of that customer, you can address that concern. Union status. Some companies have no issue with this, and others won't look at a deal if there's a union. So it can limit your pool of buyers, and you just need to be aware of that. Key employees, special skill and workforce. It's hard to find good people, and that has been a key thing in some of the deals we've done. They're looking for workforce. And then revenue in excess of 10 million. Multiples go up once you get above that level and continue as you grow. Mel, anything else you wanted to add to that?
Sure. Just a couple of comments. Maybe just to reemphasize or add a couple things here. But I mean, you mentioned growth. Yeah, and when we're talking to strategic buyers or private equity, historical is nice, but if it's flat, stable, doesn't look that exciting, they don't they don't care too much as long as it's sustainable. They use that word a lot, and there's opportunity to grow, like Don just mentioned. So what you'll see a lot of times is a company that's not growing, that is stable but has opportunity for growth, but the current ownership either doesn't have the expertise to grow it. Maybe it's a sales and marketing thing. They don't have capital to invest in certain things. And that's the type of opportunities, private equity and others look for is, well, they do have the capital. They do have certain expertise that they can add to this company to help them get to the next level. Another key buzz phrase, I guess, we've heard in the last few years is recurring revenue. That seems to be a big due diligence item now, is that when people dive into the books and start looking at, what makes this company great, they want to know about recurring revenue. And what they're talking about is, yes, repeat business, things that are there year after year, maybe contracted or monthly commitments, things like that. So that's a thing that can drive multiples as well. And then just one last thing to mention, and this is, I referred to this a minute ago, but it's when we go to market with somebody, we don't publicize a value, we don't publicize a multiple, right? We do our homework so we know where they're at. But we want the buyer to address this back to the seller. But what we think can drive a multiple in a certain case is the incremental impact that the acquisition would have to the buyer. And again, the buyer is not going to point this out, right? They're not looking for a way to pay more for the company. They're actually doing the opposite. They're looking, how can we pay less? And what are the reasons we should pay less? Well, a reason they should pay more and pay a higher multiple is, what is this going to do for them? And that's our job, if we're representing the seller, to understand that and then support it. So if they say, well, we can only pay a multiple of 4 on this business, and we say, no, you can afford to pay 5.5 because this is what it's going to do for your business. So those are the kind of things, like Don said, there's so many things that impact multiples or value, and those are hopefully just a few to think about. Okay. I think I'm next, right, Don?
Yep, you're up.
Okay, so as I mentioned, we just wanted to talk about some keys to transactions and pitfalls, things to look out for. Kind of starting out with some big picture comments here, that there's more to this process than people think, and don't underestimate it, because it will be costly. And I don't mean this to be disrespectful, but most business owners have limited or no experience in this, and they may have bought a company or two, but they still don't know a lot about. We hear it a lot. Well, this shouldn't take long. This should only take a couple months to get done. It's a pretty clean company. This should go smoothly, but there is so much to the process and so many unknowns. And we've seen this many times from parties on the other side that have taken a condensed approach to it. And I think it's been costly with hindsight. You can almost tell right away if there's limited negotiation going on or limited support for value, even a limited understanding on what makes up the value and why someone should pay a certain amount. We see it a lot with due diligence, right? When buyers just shortcut the whole due diligence process and they're not digging in like they should, they're probably going to miss something. and maybe they're going to end up buying a company they shouldn't have bought, or they're going to inherit some problems they didn't know about because they didn't do their homework. Even the definitive documents, that's the attorney's job, yes, but it's our job too. It's the buyer or the seller's job to understand those and ask questions. And sometimes we see things get passed over so quickly. I can't tell you how many times we've gotten done with a deal and somebody will say, wow, there was more to that than we thought. And that's the truth. And I guess one way to support what I'm saying about that, again, back to the private equity people, and you can, whatever you think about private equity, they do know what they're doing. They buy and sell companies. That's their job. That's how they make money. And Donna, the amount of money that Don and I see them spend in this process, it's surprising. I mean, it'll be seven figures in some deals. Over $1 million they're going to spend on outside consultants and advisors and attorneys to dig in deep. And I'm not saying you should spend that much, but my point is they think it's worth it. They think it's justified to not shortcut anything. And it sometimes will drive you crazy, but they know what they're doing, and they don't mind spending $1 million, even if it tells them they shouldn't buy a company. They don't look at that as a waste. They look at that as a good investment because they might have bought something they shouldn't have. So the main key here is to not underestimate this process and get someone involved. I'm not trying to make this a selling point of what Don and I do, but get somebody involved that has experience. Okay, next slide, Don. So back to, there's more to it than we think. The previous slide said the average transaction was 6 to 9 months. This kind of supports that. You'll see that from 2/3 of the deals that are closed take from 7 to 12 months. So, yep, 9 to 10 months is about the middle of the pack. And over the 30 plus years we've been doing this, that's pretty accurate. I think the quickest one I ever did was about 2 months. And we've had some that have gone up to 2 years too. Just they drag on. But so 9 months is probably what you can expect. And by the way, this is I'll say from the start of marketing. If you're a seller, right, it's from the start of marketing, not marketing your company. I got to back up. From getting ready to go to market to closing a deal, it's about 9 months. Okay. Next slide, Don. So talk about buyers a little bit. I don't know if anybody's on here that's more in the buying mode than the selling mode. But it's worth spending a few minutes talking about this. So I usually put buyers in one of three categories that, frankly, most owners are not buyers and will never buy another business. That's probably pretty factual. And then the other two I call casual buyers. These are the ones that, react to opportunities if they fall in their lap. The only ones they really probably ever run into are the ones that are already in market. But the proactive buyers are the ones that have a specific initiative, right? They've assigned somebody to carry out that initiative. And the proactive means they are, actually going out there and trying to find something to buy and instead of just hearing about it. Obviously, this increases the probability of success quite a bit. To talk a little more on that, Don, flip to the next slide, please. So just give you the short version of how we might approach this if someone's, wanted us to initiate or facilitate this process for them and be a proactive buyer. First of all, the number one there, it's identifying your criteria for what you're looking for, because obviously this is how you can target your search. And we spend a lot of time here, and we don't just gloss over it, but you're talking about, is it a size of company? Is it a certain niche? Is it diversifying what you already have? Is it simply volume? You just need volume because you have so much excess capacity. You're looking for a tuck-in. Maybe you're maxed out on your own capacity and you need more. I mean, we've seen that too, where people have bought companies, they could care less about the sales. They just wanted the production capabilities and the people. It could be a location. Anyway, the point here is to really hone this down. And as far as the research in terms of finding targeted prospects, which is number 6 down there, that part is a lot easier today than it used to be 20 some years ago. I mean, there's so much information out there that I think once you really hone in on what you're looking for, you can come up with prospects. Number 2, 3, and 4, I'll talk about those together. Those are kind of the financial part of this whole process or analysis for a buyer. Obviously, you have to do your own analysis of risk assessment, but financial feasibility is like, what can you afford, right? If you're a $10 million company, are you going to be looking at $50 million companies? Probably not. So you really try to figure out through a modeling of based upon your current operations, right, and your own cash flow, what you can afford. And you build these models so that you have it set up and you can do the what if scenarios. So what's my ROI on this potential opportunity? So if you're going out to buy a company and you think you know what the price should be or what you're willing to pay, but you run it through and your ROI is 4%, you're probably paying way too much for it. And the reverse can be true too, right? If your ROI is, 30%, I'm not saying you should offer more, but you've got room to go up if need be. So there's these models that I'm talking about building. I'm not going to get into all the details on it, but you build them so that you can plug in the what if scenarios. And the other thing to do here is to look for companies that provide you a different opportunity than the current owner has, if that makes sense. So whatever the current owner is doing, they're not maybe doing as well or doesn't look too exciting. But if you owned it, what can you do different that they're not doing that might produce a different result? Those are the kind of opportunities to look for, because apparently the current owner can't do it, won't do it, can't even see it. But if you can see it, then you might be able to buy the company at a good price and even get a better ROI. And then the connection with targeted prospects. I mean, once you've done all the homework and you have your target list, you contact them, right? I mean, it sounds kind of simple, and it's hard to sometimes to get through to the right person. I've made a lot of calls like this, and generally the first thing they're going to say is, we're not for sale. We're not even thinking of selling. Everything's good here. You talk a little longer and pretty soon it's like, well, I'll listen. Maybe we could have another call sometime, and all of a sudden they kind of open the door a little bit. And that's how you can identify someone that's not in market right now. And that's why being the proactive instead of the casual buyer is you're gonna get opportunities like that nobody else has right now because they're not in market. You're not competing with anybody. So the proactive approach can really pay off, but you may need to pay a premium because they're not for sale. And that might be okay if it fits your model. Okay. Let's go to the next one.
Mel, really quick before we move on, there was a question
Sure.
about that. What percentage
Okay.
of deals are completed where the seller was not actively trying to sell their business, but considered it after being proactively approached?
Oh boy, I we don't track that. So I'm just guessing, but if you get through to, I mean, you might make, 20 calls or 15 calls before you run into somebody that actually will have a conversation or two with you about this. And generally, if they're willing to open up about it, um, I don't know what the ratio is. Frankly, the amount of buyers and sellers that first engage in discussions and how many deals actually get done is pretty low. I mean, I kind of equate it to, looking for a house. You might look at 15 houses before you make an offer on one because you want to buy the right one, right? It's the same thing with buying a company. You might have to look at a lot of different companies before you find the right one. So, Teresa, it's probably pretty low, but your odds of getting a deal done or buying a company are extremely higher if you're proactive versus not.
Okay. So for those that do go through, if you're representing either party, the buyer or the seller, do you guys track that process, that transaction, and follow up with the party to see how it's going or how it went? Where does your
Oh yeah, I mean, if Don and I are engaged to help somebody, we call it a buy side engagement where they're, I guess, retaining us to do this process for them. Yeah, we're tracking everything from start to finish. So, I mean, we try to be the point person in this whole process. So the client isn't dealing with a lot of this until they have to. I don't know if that answers your question, but yeah.
would you do the same thing for if you were representing the seller?
Oh yeah. Yeah, absolutely. And that's why we decided not to go through that whole process discussion today, but we're involved from the planning, the valuation, the structuring, the marketing the company, the building of the sim, controlling the data room for materials and due diligence and the whole thing, Teresa, from start to finish.
Terrific. Thank you.
Yeah. Okay, so where was I? Oh, we're talking about sellers now. Yeah, so while, I mentioned not everybody's a buyer and you may never buy a company, at some point all owners will exit their business. That's a fact, right? And oftentimes selling is the best answer, at least I'll say financially. There's a lot of options people can consider. And we always like to tell people that the exit planning should be talked about throughout ownership. So even if you think it's years away, you should be talking about this and planning for this and tracking the value. I mean, business is high risk investment, and you didn't go into ownership to, get yourself a job. You went into ownership to build value. And if it's not going the right direction, you should be tracking this and looking at this and then thinking about how you're going to get out. If you're thinking you want to get out in the next year or two, you should be working on that right now. And there's a lot of things to do, and we, can talk about that at some point. But the 3 to 5 years, and I'll just tell you a quick story. I had a person call me about a month ago and said he wanted to meet. I met, and he bought this company 6, 7 years ago. He's built it up nicely. And then he said he wants to build it for another 5 years and then sell it. And he said, the reason I wanted to talk to you is I want to start getting ready. And I thought this was very refreshing to hear this from somebody, but he's being very proactive about making sure he positions himself properly, and he's thinking about this 5 years in advance. So anyway, I thought that was kind of neat. And that's what you should be doing too, really. And you may think everything's in order, boy, we run a clean company and all that, but there's a lot to do to get ready. Don, you want to go to the next slide? So, yeah, if you're thinking of ownership transition as a seller, we like to slow people down here a little bit and make sure it's usually a pretty emotional decision. We want to make sure you're ready. Everybody has had a bad day once in a while or a bad week, and they think it's time to sell, and then, a month later everything's great again. So we just want to make sure you're super ready emotionally, and then consider all the options. And we like to tell people you can liquidate if you want. I mean, it's usually a really bad option to choose, but we've had owners tell us, oh, I can just, sell off my equipment and my inventory and collect my receivables and I'll be fine. And obviously, they're leaving a lot on the table from a goodwill standpoint, but liquidation's an option. Transitioning to family, transitioning to management, ESOPs. There's a lot of different ways you can go, but typically, I'll say at least financially, I think selling is normally the best option. And going through a discussion about what's important to you. Don and I like to cover this with people too. Is it just simply whoever's going to pay us the most? A lot of times people start out with, well, I want to make sure I take care of my employees, and the legacy is important, the name's important, my customers are important, all these things, right? And they are important, and I don't downplay them at all. But at the end of the day, usually, the financial part is the most important for most people. And it probably should be, because again, it's an investment. The be ready part, uh, yeah, I mean, we could talk a lot about this, about what it takes to get ready to go to market or to sell your company. I'm gonna run through a little bit of a laundry list. One thing I'll just throw out right away that Dawn's going to talk about in a second, so I'm not going to get into the details, but valuation, cash flow, and structuring a deal. Obviously, there's a lot to think about there and a lot to get ready, and I'm going to leave that for Dawn in a second. But financial statements and record keeping, again, our experience has been most people think they have everything in pretty good shape, and they generally don't. I mean, it works for them and that's fine, but when you start going through due diligence and knowing what people are going to ask for and what they expect to see, those are the kind of things you want to be ready. Due diligence. We've been through this hundreds of times, and it's not just financial, it's legal, it's employee benefit due diligence, it's IT, of course, is a big one nowadays. It can be environmental, having all your contracts in order. There's just so many things to get ready. And if you're not ready, what happens is you lose so much credibility in the whole process. And then you're going to lose leverage, negotiating leverage, if you're not ready. You can't be scrambling for things, and you can't look like you don't have things in order. You're just going to end up accepting a deal you don't want.
So quick question there on sellers, Mel. What is your experience with distressed sellers? Do they make quick decisions that might not be the best interest of their company, or what's your experience?
Distressed sellers, well, if they're distressed, they may not have a lot of time for options to think about the options or to get ready to go to market. I mean, they might be forced to, and that's unfortunate, but that's one of the reasons too that we talk about this is something you should be thinking about throughout your ownership tenure. Even when times are good, when you think it's a long ways away, to start thinking about how you want to get out and when you want to get out. If you're distressed and you're forced into it, Teresa, your options are a lot less, right? And now you don't have a lot of leverage to negotiate. You pretty much have lost some of that. You still do the best you can, and it just depends how much time you got. Because when you say distress, I don't know if this is like a situation where you've only got a few months of cash flow left and you got to find something quick, or maybe you've got a year runway. I don't know. I don't know if that answered the question.
So is purchasing a stressed company a strategy for companies looking for a bargain?
Oh, it can be, sure. I mean, you're probably not going to have to pay as much, right? I mean, if you can find what it is you're looking for, going back to the acquisition criteria, um, if it's if it's simply volume you're trying to buy because that's the only way you can grow, um, or like I gave the example, maybe you're looking for production capabilities or people, and if they're distressed, yeah, you're probably not having to pay as much as you would for another type of company. But it still all goes back to the ROI. And even if it's a distressed company, there's a reason they're distressed and they probably aren't worth as much, then are they going to be as worth as much for you? That's why you got to do that analysis of what is this going to do for you and what's my ROI?
Sure, sure. Yeah, I could see where a bargain could really pay off multiple times and where a bargain could really cost your company
Yes.
multiple
Well,
times.
there's the old saying, you get what you pay for. So
Right, right.
yeah. Um, oh yeah, one other point I wanted to make on this slide is from a planning and getting ready standpoint. Well, it is anticipating the process and what to expect, but who's going to be involved internally or externally? It's obviously important to think about because most owners obviously don't want to communicate this to too many people in the company. They have to pick and choose who they're willing to bring into that discussion and when, and then who you might get externally to help too. But internally is the more sensitive one there. Just another thing to think about. Okay. Next slide, Don. Oh, this is the slide. If you don't mind, Don, can you jump in here
Yeah.
and talk about these?
Yep, definitely. So valuation, a really good place to start the process. I mean, you might not know if you're ready or not because you really don't know for sure, what are you looking at for a value. So starting with evaluation helps, set seller expectations, also helps you to understand what drives value and maybe it's not time now, but what can we do to improve the value? And starting with evaluation is a great place to start. And most printing companies are acquired on a multiple of EBITDA. So the focus in evaluation is heavily on normalizing EBITDA. We spend a lot of time trying to identify anything that's non-recurring, unusual, discretionary, one time, and really dig in deep to identify the best measure of EBITDA that we can get and support that with supporting documentation because down the line, when you do get into a transaction and you're in due diligence, and even before that, when you're in negotiations, buyers are going to challenge your ad backs and they're going to ask for support. So you want to have all that built. And there are typically a surprising number of ad backs. I've done a lot of valuations. I'll often hear our books are clean. We don't run, anything unusual through our books. So there won't be many ad backs, but there are always quite a big number of ad backs. I've done a lot of valuations. I've never seen one with no ad backs. So it can be things like professional fees, consultant fees. We always look at compensation. We look at rent, want to make sure it's market rent, market comp. You maybe have done a transaction where there could be moving costs, there could be duplication of certain positions, excess comp. I mean, there's just all kinds of things to dig into and look for. So, as part of the valuation, a deep dive into normalizing that EBITDA is really important. Once you figure out a value, the second item here, build a cash flow model. We typically, when we do this, build um, a couple scenarios, maybe three scenarios. So that, if the values, if we assume the value is 15 million, we might do one at 12 and one at 18, so we can kind of see a range of value. And what this cash flow model does is, starts with if the value is set at a certain amount, once you pay fees, pay taxes, most transactions are cash-free, debt-free, so pay off your debt. You get to keep your cash. What's left for the shareholders at the end of the day after all of the expenses. And that cash flow model is really helpful too as you're going through negotiations because you can continue as you're getting offers and looking at things and structures of deals, see what does this mean to the bottom line. And the next item there, structure of the deal, that can really impact in particular taxes, depending which bucket you put the purchase price allocation into. And there's competing interests here. The sellers want goodwill because that's at capital gain rates. Buyers want more going to equipment because they can write it off right away, get the deduction. So, it's a negotiation. But it's important to have advisors that can help you with that and work through it so you understand. I mean, it can be a lot of dollars by putting things in the right bucket. Structure of the deal, the other thing to think about, and Mel's going to talk about this next, but working capital, that also, you don't want to shortcut it. It can have a huge impact on the deal. I won't say any more about that because I know we got a whole slide on that. And then finally, with structure, there's a lot of ways the purchase price can be paid out. I mean, most sellers want all cash, but it sometimes is all cash, but rarely. There could be seller note, earn out, rollover, and the rollover, you want to make sure it's structured properly so that it's tax free. So there's just a lot of components to think about, work through, and just make sure you don't shortcut the process because it can end up leaving dollars on the table. Okay. Pitfalls, yeah, working capital. Mel, you were gonna, I think, start with that one.
Yeah, just maybe to add a little bit to the EBITDA thing Don just talked about too. She's exactly right in terms of doing a deep dive and finding, you know, adjustments to EBITDA. And again, I'm going to say that if you're a seller, I've yet to see a buyer come to the table with an adjustment that goes in the seller's favor, right? I mean, I don't blame them. I do the same thing. So if there are adjustments to be had or talked about, there's certain items that are kind of black and white, right? They're obvious. And then there's ones that aren't quite so obvious. And maybe we call these not gray area. They're supportable adjustments, but again, that's the deep dive part about it. I mean, if you think about certain things and get a little bit creative about it, you can make a pretty good argument for what's normal and what's not normal. So yeah, that's an area you got to spend a lot of time on, as Don said. Okay, so net working capital, yeah. I'm not sure if this is Don and I's favorite topic or least favorite, but it's one I do look forward to going to battle on this oftentimes with people. And literally we could spend our whole hour and a half on this topic and tell you stories, but being prepared and sellers can leave dollars on the table is so true. This is one of those pretty complicated, confusing areas that seems like it should be straightforward. and people kind of bypass it a little bit. But I'll just tell you the way this usually plays out, okay? And this is one of those things that you really got to pay attention to. So if you're a seller and the buyer comes to you with an LOI and they're making an offer, right? This is what it's probably going to say. They're going to put in the purchase price. They're going to say, we're going to offer you $10 million for your company or whatever the number is. And then it's going to say, assuming that there's adequate level of net working capital at closing based upon some target. That's kind of what it's going to say. And what often happens is you gloss over that comment about net working capital because you're just so focused on your $10 million number, because that's the exciting part. And you don't think about this working capital thing. And I think it's almost intended to be that way from some buyers. Don and I sometimes kid, we have a conspiracy theory that with some sophisticated buyers, they actually use this as a vehicle to pay for their transaction costs.
I think
And
it's a strategy, Mel. I do. I think it's a strategy to leave it till the end of the negotiation because then there's deal
yeah,
fatigue. Yeah.
yes, um, absolutely. So, yeah, Don just said we'll try to negotiate some of this right in the LOI and we'll push on it. We know they're not gonna, but we want to send the message that we're not going to fall over easy on this one. And we'll say we got to put something more in the LOI. You know, we can put a target in there now. We can identify the components. They will not go there. They will say we have to do our due diligence, our quality of earnings, and we'll get back to you later. And like Don said, usually what happens. So in the meantime, when all this is going on, due diligence and everything, Don and I are building support for our argument on working capital because we know it's coming. And so what they'll do is maybe 3 weeks before closing, they'll reach out and say, okay, we got to have a meeting on working capital. We're done with our analysis. We got to have this discussion because the attorneys need to put it in the agreement, and they'll kind of downplay the whole thing and they'll pretend like it's not a big deal. And then Don said, usually people have serious deal fatigue by now and they don't care anymore. They just want this to be over with. And so the buyer will, I'll give you a real life example here. We've got a lot of them we could share, but just to tell you the magnitude of some of the things we've seen. So we had a deal that closed a few months ago. It was a pretty high value deal. They didn't have a ton of working capital, but the buyer did exactly what we thought. 2 weeks, 3 weeks before closing, they wanted to have a meeting, and I had done my homework, and they presented their big pitch in this meeting, and they said, we think the target should be 1.3 million. And I said, no. And I told them all the reasons. And then I made my pitch for, well, here's the support I have and the reasons for it. And I think it should be 800,000. Well, look at that. There's a $500,000 difference on 1.3 million. So it's like 40%. So just to tell you the magnitude of this sometimes. Well, in the meeting, they agreed to go down to 1 million. I said, no, 800,000. And they said, well, send us your support and information for that. We'll have our consultants look at it and get back to you next week. So we sent it to them. Within an hour, they called back and said, we're good with the 800. So, I mean, we just saved $500,000 on that deal. It's real money. So if you understand the target of working capital, what in my example I just gave you, if the buyer's saying it has to be 1.3 million at closing, and we only deliver 800,000 because that's what I think the average is for them, the purchase price would have been reduced by $500,000. So that's the way it kind of works. And I gave you the simplified version of it, but it's a real thing. And just beware when you get into those discussions because you can leave a lot of money on the table. I don't know if you had anything more to add on that, Dawn?
Well, yeah, where we really see it add up is when you have healthy companies with really healthy balance sheets and they have excess working capital, more than the industry average. And some sophisticated buyers just like to say, well, we're going to just use the 12-month average of your historical. And that's too high because this company is carrying excess working capital. So we make an argument that no, it needs to be more of the industry average, um, not this excess. The excess should go to the seller. But that happens. That happens frequently, and it can be $1 million, $2 million of excess working capital.
Yeah, good point. I'm glad you brought that up, Don. That is often the case. Um, the premise there isn't average working capital, it's adequate working capital. And there's a difference, and that's what Don was saying. Average might be they have excess all the time, and the buyer needs to pay for that excess. Um, Another favorite one of mine is when they say, well, this deal's been going on for 9 months. We should really look at the working capital that's going to, on average be there at this time of year, because it's a seasonal business or something. And what I like to say in response to that is, well, if you want to use the seasonal net working capital, then let's use the seasonal EBITDA to determine value. And right away, they don't want to go there, of course, but just be super careful with this area. It's complicated, and it's not just what Don and I were talking about. It's the components too. So a lot of people, this next bullet point item here about problematic accounting errors, not GAAP. Yeah, again, most people are going to say their financials are in good shape. We've been doing them the same way for 30 years. They've served us well. But you know what? They may not be GAAP. Maybe you're not accounting for customer deposits properly or prepaid expenses or certain items that can also change your EBITDA outcome, but impact working capital. So you have to, because the buyers are going to dig deep, and they lay out a monthly spreadsheet, and sometimes for 24 months, and they pin this down to what they think is right. Well, not what's right, but what they want to support, right? And what they want to argue. So I know, Don, you've run into a lot of accounting things, and it's not to say people's financial statements are wrong, but because they work for them, but now we're in a different deal
Right.
here in the transaction.
Well, and sellers are repping to the fact that their financials are accurate. And typically the reps also say that they're in compliance with GAAP. And GAAP has had some changes in the last few years with revenue recognition and lease accounting. And if you have finished good inventory, I mean, you should make sure you're in compliance. Or if you're not, you want to make sure the rep states those discrepancies so that you're not creating some risk for yourself down the line. Maybe there's some, if it's not accurate, there could be some indemnification or something down the line because you've repped that it is accurate.
Yeah. So, well, like I said, we could talk a long time on working capital and stories, but I hope you get the message that this is a very sensitive area, and it's just beware and be on your toes and be prepared, I guess, to make the proper argument on your behalf. Okay, Don, next slide. Okay, so I'm just going to wrap up here with a couple slides on some other reminder items to think about if you go through a transaction or are thinking about it. So due diligence, right? And I mentioned seller due diligence. So if you're a seller, don't think it's just the buyer that does all the due diligence. You have every right, and you should vet these buyers out, ask questions, ask for information. Simple things like, well, well, buyer, you told me you're going to buy my company and keep running it. I want to see your financial statements. I mean, why not? They don't have to give them to you, but why not ask the questions? So you do your own due diligence is the point here. Buyer due diligence. Okay, now you're the seller and this buyer comes with pages of requests, right? I mentioned all the different areas they might ask about. Um, and I'm saying here, you can push back when appropriate, right? They're gonna just throw everything at you, and they know you may not even track some of these things, and you shouldn't have to go create it just for them. And in a lot of cases, so you can push back. I also say be patient with this and try not to be defensive, because it can get irritating. It seems like they're just trying to find something wrong with your company because that's their job. So that's where you can get a little defensive and you just have to kind of roll with it. We like to say, this gets back to being ready, anticipating their request and knowing what they're going to ask for. The better prepared you are, the smoother this whole thing goes. Reps and warranties and indemnifications, just a good reminder here that sellers are often surprised and they don't understand this area. It's usually sometimes it's negotiated in the LOI, but for sure it's going to be in the definitive agreements. And it's usually several pages about this, and you kind of again gloss over it because it's a lot of legalese and terms. But the bottom line is that as a seller, you're making certain reps and warranties and disclosures of what your company is and what the buyer's buying. And if you're wrong about that or didn't tell the truth or whatever, they have these clauses in there, and they're usually based upon different types of reps and dollar amounts and caps and time periods that they're going to be in existence for. And try to understand it. It's the attorney's job to protect you here, and our job to help in this discussion, but there is a market for all these items. You'll often hear, well, it's market that these should only be, 12 months or whatever. So don't just pass over this area. It's pretty important. Next.
Yeah, I
Go
was
ahead,
going to
Don.
mention one thing there too. It's always good to be working with an M&A attorney when you're going through a transaction too, because they know what's market and where to push back, and um, they'll pay for themselves. It's worth using an M&A attorney.
Yeah, good point. Good reminder, because we'll ask people, do you have an attorney? And they'll say, oh, yeah, it's, so and so. He was my dad's attorney and he's been our business attorney for 40 years. Well, they may not be an M&A attorney, and you need an M&A attorney. Um, Purchase agreement disclosures. These are part of the definitive documents. And you might say, well, doesn't the buyer put all these together? Yeah, they usually draft them. I mean, you're negotiating a lot of things in the agreements, of course, but it's the seller's responsibility to draft really the disclosure statements. And these are things you're disclosing about your company that are supposed to be true and accurate. So pretty important. Yeah, I'll just give you a quick example that Don and I see on most every deal. We'll tell the sellers, okay, you got to identify every single contractor commitment you have in the company right now. And they often say, well, we don't really have many. I mean, I don't think we have any contracts. I can't think of a commitment we have. And we'll say, well, keep looking. We'll
Mhm.
come back to you on this one. And pretty soon they'll say things like, oh yeah, we have a snow plowing a contract, which is not a big deal. But we have an IT maintenance agreement. We have this or that. And usually there's more there than you think. And you're asking the seller or the buyer to take these over. Well, they really can't take them over if they don't know about them.
Yeah, it's really important to identify all of them, and that list almost always gets to be pretty lengthy. Software
Yeah,
agreements. I mean, there's a lot of agreements once you start digging in.
right, right. Um, Okay, employees, customers, vendors. We like to remind the seller clients that they control this communication prior to closing. Once closing passes, you don't control it anymore, right? So if there's a way you want to handle telling your employees, telling your customers, notifying your vendors, then be proactive and have a plan to do that. If not, they might find out at the day of closing unexpected, not the way you want it to happen, or they might, a customer might find out the day after, and that's not so good. So have a plan. Post closing, yeah, things generally don't end here. Both for buyer and seller. So more important for the buyer, obviously, but what happens a lot is, that deal fatigue thing we talked about earlier. So you might spend 9 months and it's very intense, daily, stressful, right? And you finally get to closing and it's a big relief and a celebration, and you should. But then the next day reality hits and now somebody else owns this company. They really should have a conscientious post-closing plan. We've seen a couple bad ones, where buyers didn't even address how payroll was going to be done afterwards. And sellers, you're not done at closing usually either. So just be aware of that. Remember all that talk about working capital? That's generally one big item that has to be addressed, because you're closing on numbers for working capital, but you're basically estimating, because you can't possibly reconcile those numbers on the day of closing. So now 60 or 90 days later, you have to true all that up. And there's other things that need follow-up post-closing. So buyer and seller both have issues here, and just be prepared and plan for it. Okay. Let's see. I guess we have 10 minutes left of our allotted time. Teresa, any other questions that have been chatted in?
There are none in the chat currently, but this is the time that we want to encourage people to ask those questions. So we'll give them a few seconds to enter information in there. It looks like we have some coming in. Are most deals completed with an earn out versus cash purchase? If so, what percentage of these actually get the entire earn out? And what's the earn out timeline?
I guess I'll go first, Don. You can follow up, but I'd say we just had this conversation last week with somebody. If it's a tuck-in situation, most of those deals have an earnout, because there is uncertainty of future revenue retention and so forth. And the time period that most of them last, it's all negotiable, to be honest. We've seen 2 years up. I think the longest one we had was at 7, Don?
Yeah,
7 years?
yeah. Usually they're like three years,
Yeah.
2, 3 years.
Typical 3 to 4. Now, the big question about, do they usually get collected? I know this is what people worry about the most, right? As a seller, well, we'll never see that money. We've only had one situation that isn't totally resolved yet, and we think it will be in our favor. But yeah, they're. I've never seen one not get paid that's due now. This is where you negotiate the terms, but then the definitive agreements have to be written in such a way that protects you against those types of things, right? And we want them to be typically based on a gross revenue or a value-added revenue as opposed to net income. But what are some of the protection things? Getting reporting from the buyer on a regular basis, being able to scrutinize or ask questions, setting due dates for when payments are due. I don't know, Don, do you have anything more to add?
Well, just making sure you're clearly identifying that customer list, who qualifies. And
Good
if there's
point.
multiple locations, you want to make sure that work is not moving from one plant to the other, or if it is, that it still qualifies. There's just a lot of things to think about and build into the agreement to protect yourself.
Excellent. That's a lot. A 7-year earnout is a long time.
Yeah,
Yeah,
that's unusual.
that was unusual.
Yeah.
Um, Teresa, or for everybody, I guess, again, if questions come up that you didn't think about right now or you want to ask later, our contact information is available on that handout, so just reach out anytime.
Terrific. There's another question here. What's your experience with written transition plans? If there's no plan in place at the closing of the deal, how does that work out?
Well, I think the question refers to the post-closing plan, I think, and that kind of what I just talked about at the end, and that's why we put that comment in there that there should be a written plan. There should be, and it should be a communication too between buyer and seller about what's going to happen. The ones that don't have a very good plan, problems happen. I mean, I know one from it was about 2 years ago now, maybe it was 3 years ago. There was no plan, and we were representing the seller, and the buyer really didn't have a plan. They said they did, and not to worry about it. But this is the one where they didn't even have payroll set up. So their employees were like, okay, it's payday. Where's my paycheck? And so,
Hmm.
and it's vendors, it's customers not knowing what's going on. So pretty important. You know, it's primarily the buyer's responsibility, right? Because they're taking over the company. But if you're a seller, it maybe doesn't hurt to push that a little bit too and ask questions about that, or what is the plan? And oftentimes the seller's involved for a while too, the owner, right? They're part of that transition plan that they want them to stick around and help, navigate some of these things. Don, anything else?
Well, yeah, we do find that private equity is usually pretty good at this, a little more sophisticated. They've got kind of their checklists and their transition plans and have a lot of transition meetings throughout the process, even before closing. So, yeah, if it's something you're familiar with and used to doing, it gets done pretty well. But sometimes the one-offs, it's all new.
Yeah, good point.
Yeah. Is that something that you guys assist with putting in a LOI, a letter of intent? Is that transition plan?
Usually don't see it addressed there, Trees, because it'd be pretty hard to really identify that other than in a letter of intent say, promise that they will have one, and that will be communicated before closing. That might be something that could be included in an LOI, but they're not going to get into specifics in it. But not a bad thought.
Yeah.
Yeah.
Okay, we are coming up on the top of the hour. If there are other questions, please put them in the chat at this time. There's one last one that just came in. We have a group that's in a transition and they're working on transitioning the banking information and vendor relationships. Do you have people on staff with expertise in that process?
On staff, you mean, I'm not sure I understand the question. You mean Don and I staff, or?
I think they mean can LB transitions help them with that?
Well, we can, yeah, I mean, we can help with a lot of different things, but if you're talking about communicating with vendors about, I mean, I'm not sure I understand the question exactly.
So as they transition their banking information and vendor
Oh,
relationships, can you provide guidance or recommendations on how to go through that process?
oh, banking. I didn't hear the banking part.
Yeah,
Yeah,
banking.
that's Yeah, I mean, I don't know. That usually has to be handled with internal management. Now, it should be on somebody's checklist to make sure it gets done. This goes to the post-closing checklist or plan, right? But it's not something that I'll say Don or I would have the authority to, you know, to actually do it with the banks. I mean, I think that has to come from the ownership groups.
We have a member that just commented on that as well. That is a fractional CFO that says they're a good resource for helping with banking relationships and those types of transitions. And so I can easily connect those two members
Sure.
offline via email and maybe help in that area.
Great.
Okay, 2 minutes. Any last thoughts or comments on the process? The industry is very active in mergers and acquisitions, and a lot of our members haven't been involved on one side or the other, either their company being purchased or they're purchasing companies. What are your last thoughts?
Well, our last thoughts, hopefully some of the things we pointed out today were meant to not get into the weeds on the whole process because there's a lot to it, as we said. It's more just these helpful reminder points that can, cause either a seller to leave money on the table or a buyer to pay too much, things like that. So a lot of things to be careful about. I do think I've been doing this for 30 plus years, so has Don, and we're still learning. So, I mean, if somebody's been through one or two transactions, and this is the part I don't mean to be disrespectful, but there's a lot you don't know. And get somebody to help.
Excellent. We will be providing a link to the recording as well as a PDF of the slides to the members that are online. Dawn and Mel, if you will double check and make sure your contact information are in those slides. So if anybody on the call has specific questions, they have your contact information to reach out directly.
I think it's on the cover page, isn't it, Don?
Yep.
Yeah. Okay.
Excellent. Terrific. Well, thank you for the information. Terrific content that we all need to be aware of. We appreciate it.
Yeah. Thank you.
Thank you.
Everyone have a great afternoon. Bye-bye.